Picture this, a giant video store filled with movies and TV shows. But instead of renting, you can buy a tiny piece of each movie or show. That's kind of what the stock market is like. Each piece is a share of a company like Netflix. When you buy a share, you own a small part of that company. And just like a hit movie can become super valuable, so can a successful company's stock. But unlike a video store, the stock market never closes. It's open 24/7, with people buying and selling shares all the time. Think of it as a living, breathing organism, constantly reacting to new information and investor sentiment. It's a fascinating and complex system, but don't worry, we'll break it down together. Let's say you love watching Stranger Things on Netflix. You think Netflix is doing great and will continue to make awesome shows. You might decide to buy some Netflix stock, becoming a partial owner. You buy your shares through a broker, like a digital middleman. They connect you to the stock market and execute your trades. Now, you're a Netflix shareholder. If Netflix does well, the value of your shares might go up. You can then sell those shares for a profit. But remember, the stock market can be unpredictable. If Netflix releases a flop season, the stock price might drop. You could lose money if you sell for less than you bought. Think of the stock market as a grand play. Investors are the audience, eager to invest in promising shows, companies. Companies are the performers, showcasing their growth and potential. And brokers are the ticket sellers, connecting investors to the action. Investors come in all shapes and sizes, from individuals like you and me, to giant institutions like pension funds. They all share one goal: to make money by investing in companies they believe in. Companies, big or small, need money to grow. They can get it by issuing stock, essentially selling small pieces of ownership to investors. And finally, we have the brokers. They act as intermediaries, executing buy and sell orders for investors. Think of them as the bridge between your money and the exciting world of the stock market. How is the price of a stock determined? It's like a giant auction. Buyers and sellers constantly place bids and offers, and the price fluctuates based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. But it's not just about numbers. Stock prices are influenced by a complex mix of factors, including company performance, industry trends, economic conditions, and even investor emotions. It's like a giant puzzle with constantly shifting pieces. Understanding these factors is key to making informed investment decisions. Section 5. The ups and downs of stock prices. The stock market is like a roller coaster, full of exhilarating highs and stomach-churning lows. Stock prices can be volatile, changing rapidly in response to news and events. One day, a company might announce a groundbreaking new product, sending its stock soaring. The next day, a global pandemic might hit, causing a market-wide crash. It's important to remember that investing in the stock market always involves risk. You could lose money, especially in the short term, but over the long term, the stock market has historically trended upwards. Section 6. Why do stock prices change? Imagine a news headline: Netflix surpasses subscriber expectations. Investors get excited, anticipating higher profits. Demand for Netflix stock surges, driving up the price. On the flip side, a headline like Netflix loses subscribers due to increased competition could spark fear and uncertainty. Investors might sell their shares, causing the price to drop. Company performance, economic indicators, political events, technological advancements, and even natural disasters can all influence stock prices. It's a complex web of interconnected factors. By staying informed and understanding how these factors interact, you can become a more savvy and confident investor. Section 7. The thrill of the ride: risks and rewards. Investing in the stock market is not for the faint of heart. It's a roller coaster ride with inherent risks. But for those willing to buckle up, the potential rewards can be substantial. The biggest risk? Losing money. Stock prices can fluctuate, and there's always a chance your investments could decrease in value. However, there's also the potential for significant gains. Over the long term, the stock market has historically trended upwards. By investing wisely and holding onto your investments, you can potentially grow your wealth significantly. But remember, investing is a marathon, not a sprint. Patience, discipline, and a long-term perspective are key to success. Section 8. Dip your toes in the market: tips for beginners. Ready to embark on your stock market adventure? Here are some tips for beginners. Start small, don't invest more than you can afford to lose. Do your research. Understand the companies you're investing in. Diversify your portfolio. Don't put all your eggs in one basket. Think long-term. Writing out market fluctuations is key. Seek professional advice. Consult with a financial advisor if needed. Remember, investing in the stock market is a journey, not a get-rich-quick scheme. By starting small, educating yourself, and seeking guidance when needed, you can navigate the exciting world of investing with confidence. Section 9. Stay curious. The stock market is a fascinating and ever-evolving landscape. By staying curious, continuously learning, and adapting to new information, you can become a more informed and successful investor. Remember, the stock market is not just about numbers and charts, it's a reflection of human behavior, innovation, and the constant pursuit of growth. So, embrace the challenge, enjoy the ride, and never stop exploring the boundless possibilities of the stock market.